Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Understanding Capital Structure, Key Insights for Businesses and Investors. Capital structure plays a key role in shaping a company's financial health. It refers to how a business funds its operations and growth through debt and equity. Understanding this balance is crucial for making informed investment decisions. For business owners, capital structure impacts everything from day-to-day operations to long-term strategy. For investors, it reveals a company's risk level and potential for returns. In this video, you'll discover the importance of capital structure, the different types, and how it influences overall business performance. By the end, you'll have a clearer view of why it matters and how it can affect your financial choices. What is capital structure? Capital structure is a critical financial concept that outlines how a company funds its activities through a mix of debt and equity. It's like the foundation of a building. Without a solid structure, everything else can collapse. The way a business balances these two elements can significantly impact its operations, risk, and growth potential. Definition and components. At its core, capital structure refers to the different sources of funds a company uses. Typically, these sources fall into two main categories: debt and equity. Debt financing. This includes loans, bonds, and credit lines that a company must repay with interest. Using debt can amplify returns but also increases financial risk. Equity financing. This involves raising capital by selling shares of the company. Investors own a piece of the company but have no obligation for repayment, which can stabilize a company's finances. The right mix of these components is essential for a company's success. For example, a capital structure heavily weighted towards debt can lead to higher returns in good times, but it also increases vulnerability during economic downturns. Conversely, a structure that relies more on equity can be safer but may limit growth potential. Significance of capital structure. Understanding capital structure is vital for both companies and investors. For businesses, it influences several factors. Cost of capital. The mix of debt and equity affects the overall cost of capital. A well-structured capital base can minimize financing costs and maximize growth. Financial stability. A balanced capital structure can enhance stability, making it easier to weather financial storms. Growth opportunities. Companies with flexible capital structures can more easily take advantage of new opportunities or expand operations. For investors, capital structure reveals the company's risk profile. A company with high levels of debt might promise higher returns, but it also comes with increased risk. Here are some reasons why understanding capital structure can guide investment choices. Risk assessment. Recognizing how a business finances itself helps investors gauge overall risk. Cash flow management. A company's capital structure impacts its cash flow, affecting its ability to pay dividends and reinvest profits. Investment decisions. Investors may opt for companies with stronger financial footing to mitigate potential losses. Whether you're running a business or eyeing potential investments, grasping the concept of capital structure can equip you with the necessary insights to make informed financial decisions. Types of capital structure. A company's capital structure can take many forms depending on its funding needs, risk appetite, and growth strategy. Understanding these types allows business owners and investors to make better financial decisions. Here's a breakdown of the main types of capital structures. Equity financing. Equity financing is when a company raises money by selling shares. Investors buy these shares and own a small part of the business. This form of funding comes with several benefits compared to debt financing. No repayment obligation. Unlike loans, equity does not require repayment. This reduces financial strain. Shared risk. Investors share in the business's success and failures, lowering individual risk. Increased capital. Companies can raise significant funds without incurring debt, making it easier to finance growth projects. Stability in tough times. With no interest payments, companies can better manage cash flow during downturns. This approach can attract investors who believe in the company's vision and want a stake in its potential. Debt financing. Debt financing involves borrowing money that must be repaid with interest. Companies can choose from various forms of debt, each with its own features. Loans. Traditional bank loans usually have fixed repayment schedules. They work well for predictable funding needs. Bonds. Companies can issue bonds to the public. Investors buy these bonds for periodic interest payments and return of the principal at maturity. Credit lines. Flexible borrowing options allow companies to withdraw up to a certain amount as needed. This is useful for managing cash flow and unexpected expenses. Leases. Instead of buying equipment, companies can lease it, spreading payments over time. Debt financing can boost returns by allowing companies to use borrowed money for expansion. However, it also adds financial risk, especially if revenues decline. Hybrid structures. Hybrid structures combine elements of both equity and debt. A common type is mezzanine financing. This involves subordinated debt or preferred equity, typically used by growing companies that have already tapped out traditional financing methods. Mezzanine financing. This approach allows for higher investment returns in exchange for increased risk. It comes with flexible repayment options and can convert to equity if the company cannot repay. Preferred stock. This is another hybrid form that gives shareholders priority over common stockholders during liquidation, but doesn't come with voting rights. Hybrid structures offer flexibility and can be tailored to meet specific business needs while balancing risk and reward. Understanding these types of capital structures is essential for effective financial management, whether you're running a business or investing in one. Factors influencing capital structure. Capital structure doesn't just happen. Several factors come into play when a company decides how to fund its operations. Let's break down some of the main influences on a company's capital structure. Market conditions. Market conditions can significantly influence a company's capital structure. When interest rates drop, borrowing becomes cheaper. This can encourage businesses to take on more debt. Conversely, in a rising interest rate environment, companies may hesitate to incur additional obligations. Investors also pay close attention to market trends. If equity prices are strong, a company might opt to issue more stock, capitalizing on favorable valuations. A company will weigh its options based on the overall market landscape, including interest rate trends. Lower rates incentivize borrowing. Investor sentiment. Positive market sentiment can lead to easier equity financing. Economic cycles. During a recession, companies might focus on reducing debt. Understanding these conditions helps businesses tailor their financing strategies to capitalize on current opportunities. Company size and maturity. The size and maturity of a company can also dictate its capital structure. Startups often rely heavily on equity. Investors want to share in future growth without the burden of repayment. Heavy debt can be risky for new businesses still finding their footing. Established companies, on the other hand, tend to have a mix of debt and equity. They can utilize strong cash flows to support debt repayment without jeopardizing ongoing operations. As companies grow, their needs change. Larger firms may have more access to financial markets and offer lower risk to lenders, allowing them to take on more debt. Factors to consider include cash flow. Stability. Strong cash flow can support higher debt levels. Growth opportunities. Companies in growth stages might prefer equity to avoid the pressure of debt obligations. Market position. A leading firm might secure better terms on loans than a smaller competitor. Size and maturity influence a company's ability to manage debt and equity effectively. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.